Now, the US dollar has lost about 10% of its value on what's called the DXY index this year so far. So you might be thinking, well, if the dollar's down, then the euro must be up. And you'd be right in that, because obviously it's a zero-sum game if currencies have to even out globally at the end of the day. So 10% down for the dollar. The euro is up 12% so far this year. But meanwhile, what do you reckon gold's doing? It's up 25% so far this year. So are all of these things linked? Well, Steve, first of all, the reserve currency, the US dollar, it has to be stable to be a reserve currency, and it's not been a lot lately. It continues to be used as the currency that people like to trade in, but what is definitely changing is it's not the currency that people want to use to invest in. So US bonds, usually a safe choice, are now seemingly less of a safe choice. And I guess that goes with the fluctuation of the US dollar, doesn't it? Because if you buy a lot of US treasuries in US dollars and then the US dollar loses value, then the value of those treasuries that you've bought have lost value and you've lost out as a consequence out of that. And I think that's happening quite a bit. But I think the payment side of things is still going on because there's not really much choice. I mean, there might be a slow decline from people trading in other currencies, but it really is this issue about people buying securities in the US, buying bonds, buying shares. They seem to be fleeing out of the US, and that's what people are calling this de-dollarization. It was happening anyway, but it's become more pronounced, it seems, since Donald Trump came along.
Yeah, well, isn't that amazing? I think it's. I mean, you can see you have to separate the dollar itself and dollar-denominated assets. But as you say, if you're an international portfolio manager and you're trying to guess where you put the firm's funds, do you buy European bonds or do you buy American bonds? Or what's happening to the exchange rate is a major question in that. And that's quite a substantial fall. You talk about a 10% fall. That's the sort of level of devaluation that was seen as a critical change back when the days when there used to be fixed exchange rates. So back then, the last time I remember in this case, the Australian government was debating whether they would or would not devalue. This is before the floating of all currencies. I think it happened about 1973. And there were debates whether it would happen or not one day, and the next day you woke up was devalued by 17.5%. So that was a substantial change in the sums for anybody doing international transactions. So this is clearly going to be hitting anybody doing portfolio allocation right now.
Yeah, well, but this is so when it comes to where you putting where you parking your money, in effect. So foreign reserves. If you're a foreign bank or you're a big investor and you're wondering, do I put money into Europe? Do I put money into the United States? That has been slowly sliding. Even before Trump. So as a proportion of foreign reserves, the US dollar accounted for 71% in the year 2000. In 2016, it was about 63% in 2016 from 71% in 2000 and 58% in 2022. So from 71 to 58, that's quite a big jump. And now it's starting to accelerate since Donald Trump came along. So it's not a pretty picture.
It's not, and this is the hole in the argument that I'm having with MMT advocates right now over the exorbitant privilege of the American dollar, because it's only exorbitant privilege while it works, while it continues. And when you have that decline in the proportion of trade and proportion of assets that are denominated in the dollar, then at some point there'll be a break, and you can't say when it's going to happen, clearly, but that's not a trend which means you're sustaining your preeminence.
No, but the fact that it happened before Trump came along, what was driving it before? I mean, now it's clear because there's it's an unstable government, and I love your follow me.
I've got to stop. I keep on trying to turn it off, and it keeps on turning itself on. I'm supposed to what they call artificial intelligence.
Steve's got this follow me camera. But anyway,
while you're chatting, I'm going to see if I bring up the command that told it not to do it.
Right.
Naughty controller, bad controller.
Here we are.
But
on
it's
the fly.
doing it again.
You can tell we do this as live, but anyway, yeah.
It's actually not supposed to be happening.
All of this was happening before Donald Trump came along. He's just made it worse. So it's understandable why it's happened now, because he has created a less stable government and people are concerned about the the future of the US economy, and obviously the value of the US dollar. As I said before, no point in holding assets if they're going to lose value because the dollar is going to weaken. But why was it happening before? Is it just because there's more opportunity now to trade and there's a broader set of assets, so you don't need to be quite so US central?
Yeah, well, it's partly the fact that globalization has been financed as international. And to quote, I don't actually have the reference here, but a colleague of mine, the systems engineer in Norway, Trond Andresen, found it in Keynes's writings when he said at one point, and above all else, let finance be national. Well, that's the exact opposite of what we've enabled with the Bretton Woods scheme that was imposed upon us by the Americans rather than the one that Keynes wanted. So finance being international, it's financed in the American dollar. That gave America enormous privilege, and that's where the vampire squids of finance have come from. But what it also means, that it was originally called the Dutch disease. It's clearly something which happened to more than just the Dutch. If you have a reason for your currency to be overvalued respect to your manufacturing capability, then your manufacturing capability declines. That was Dutch in terms of oil reserves, I think, at the time. But for America, exorbitant privilege of being the international currency, which should not have happened. What it means is American dollar gets overvalued. Their exports have declined. Yes, it's got some service exports compensate to a significant degree, but America's still running an overall balance of payments deficit, and that's just sitting in what I see as an inexorable trend for the American manufacturing sector and the American economy to be weakened, and ultimately that means you can no longer project your power through the exorbitant privilege of being the international currency.
And how much?
So that's been
that's been going on for a while. But how much of that do you think the value of the currency is related to the interest in the investments in that country? I mean, I'm imagining, I don't know this for a fact, but that would completely, the scale of that would be considerably larger than just the amount of trade, the value,
Yeah, well, it's financial market asset gambling and price gambling is absolutely gigantic. I think you'll see reports of the volume of financial transactions being a factor of 10 or 100 larger than the actual transactions for goods and services. So the layer of speculation on top of the actual real foundations of trade and goods and services is huge. And again, it's all wasteful. As Keynes saw it, was just shuffle. It's shuffling the deck chairs type rather than actually steering the ship.
But it does have an impact on the currency, obviously, as we're seeing now, and then the value of that currency has a big impact, not just on those future investments, but it obviously has a big impact on trade as well. So a weaker US dollar is not going to be so good. I mean, it's
and if you have US investments, they're declining in value, even if they might be increasing domestically, but declining internationally in value because of the falling dollar. So any corporations with foreign holdings, which is virtually all major corporations these days, they're going to want to have less American dollars, and that's one of those amplifying feedbacks. I hate the term positive feedback. Positive implies good to most people, but an amplifying feedback, if the dollar goes down in value, then your assets in America are worth less, which means it's a good idea to sell some of the assets, which means your assets go down in value.
Right.
So you get this amplifying trend away from a stable dollar rather than returning to it.
But wouldn't that become self-correcting though? So if you've got, if you've got a weaker dollar, then all of a sudden people go, well, now's the chance to buy assets, whether it is bonds or whether it's buying American companies or whatever. You'd imagine that the money would start to flow back in, and then things would start to correct themselves, unless there's a long-term risk concern.
Well, I think the long term is the one that's actually laying the foundations here. There are at least two elements to the long-term trends. One is the decline in American manufacturing, which means that whether you want it or not, if you want an air conditioner, you've got to convert your American dollars into a Chinese renminbi to buy the air conditioning unit or the car or whatever else. But you've also got the extent to which America has weaponized the dollar, and this is the thing which we've been confronted with so many times, not just with Trump. If you go, I think about the time of Bush, one decision they made was to take Iran off the SWIFT system, I think. And SWIFT is actually, the SWIFT is the foundation of the actual international transactions, is the telecommunications system, which is what SWIFT is. It's not actually it's not a bank account system. It's a telecommunications protocol between financial institutions, and it uses the American dollar.
Like a
So
signaling
when
system, like in telecommunications, you have a signaling system as well as the
yeah,
voice calls. You get the signaling for that voice call. Same
yeah,
sort of idea.
same
Yeah.
sort of thing. So like SWIFT, I think refused to let Iran, certainly refused to let Iraq
Mm. And
use the
Russia now,
American dollar. Sorry?
and Russia now, I think as well.
Yeah.
Yeah.
And what that means is, well, if you can't use it, create your alternative. That's what
Mm.
ends up happening, and we're seeing that now much more widespread. So we had the first collapse of Bretton Woods, as defined by the Americans, by Harry Dexter White, in 1971 when Nixon abrogated the gold standard, and that was because when America, in the person of DW, let's call him DW,
Mhm.
HDW, Harry Dexter White, in his person insisted the American dollar should be used for international trade rather than creating the neutral a unit of account that Keynes called the Bancor. Then at that stage, America was running a huge trade surplus because it was the only country that had factories that hadn't been bombed. This is a
Mm.
huge element. And they basically thought, oh, we're going to get this is going to go on forever. Well, by setting up the American dollar as the unit of exchange and the currency for international trade, then it got overvalued, and that meant its manufacturing surplus declined, partially compensated by a services surplus, again coming out of the fact you needed American merchant banks and the like to arrange your international financial deals. And you were gambling on all sorts of other assets using the American dollar. But fundamentally, it turned the corner in terms of the trade surplus in 1973. So it's been running a deficit with very rare exceptions ever since 1973 in trade, and equally when you include services, it's still running a deficit there. So this is just, I think, the long-term effect of, by making the American dollar the reserve currency, you set it up for a fall.
And the fact that, because it was seen as being the safe choice, this reserve
Mm.
currency for such a long time, if you had money to park somewhere, if you were balancing your portfolio globally, you'd say, well, okay, let's put a huge chunk of it into America because that's the safe portion. If we want to be ultra safe, let's buy US Treasuries. Let's buy government bonds in the United States because we
Mm.
know we're always going to get that money back. We know the exchange rate is going to be, relatively stable. We're not going to see a crash in the value of the US dollar. So, it was the world's safe haven, wasn't it? Really.
Mm.
Um,
And that had a perverse effect during crises because it
mm,
meant the dollar would actually go up
mm,
during crises because everybody was buying into it to get their money into what they saw as a safe haven economy.
yeah. So, but now the opposite is happening.
Mm.
So the value of the dollar is going down. People are trying to get money out of US bonds. They go do it quickly. It's sort of like it accelerates, which I think is what we have been seeing because let's get the money out before the dollar goes down too much. But that at a time, I know when you say government debt doesn't matter too much, because you can always issue more. But the US government is issuing a lot more bonds, more than ever before, and yet there's less demand for it. So that is going to have an.
We're going to be careful here. Again, the double entry bookkeeping is critical to understand this. So I've seen scare videos on YouTube which I've written critiques of where they say, oh, this municipal bond failed in Japan. Well, municipal bonds are not created by the national government.
Sure.
Municipalities can run out of money. The same sort of thing. When you look at the primary auction, the funds, not the money, that's used to buy those auctions, which run at like they're weekly auctions, pretty much,
Mm.
which means you've got 50 of them in a year. So if you're carrying 100% of GDP as outstanding debt, you might be issuing, say, 2% of GDP worth of bonds per week. And if you don't have enough reserves in existence to buy those before they're sold, this is countering one of the typical
Yeah.
brain dead arguments I've seen against it. Then there's 100% of bonds out there, 100% of GDP worth of bonds. The reserve can do open market operations, buy some of those bonds off the financial institutions, both banks and non-bank financial institutions, increase the amount of funds in reserves, and then when the auction takes place, everybody who's got those reserves wants to swap them for the bonds. So the primary auctions will never be damaged by this sort of thing, but it's the secondary sales when the banks themselves and some of the primary dealers, having bought all these bonds, then sell them, trying to make a trading profit to non-bank financial
And
institutions.
find there's
And
not much demand for that.
That's why not much demand. So therefore, when they sell, you get a lower sale price, and that translates as a higher rate of interest. But that's occurring on the secondary market. On the primary market, the classic saying, and it makes absolute sense: don't fight the Fed. And the reason being that if you the Fed has, because it's a bank for the banks, it has an unlimited capacity to buy bonds off the banks. If the Federal Reserve if you wanted to eliminate America's terrifying level of government debt, make me governor of the Federal Reserve for 35 seconds, and in that 35 seconds I'll buy $40 trillion worth of government bonds, and therefore the government will owe the debt to itself,
like the Bank of
pay
Japan
no interest on it,
like the Bank
end of panic.
Like the Bank of Japan was doing, where they
fundamentally the same thing. Yeah. So there's the Fed has limitless capacity. It doesn't even face the constraints of having to be a positive equity, which is a constraint that controls what private banks do.
Right.
So with that capacity,
so is endless. But the fact that they do want to pass it off to the secondary market, and the secondary market,
you have trouble, and that's where you get the price.
But do they need to do that? I mean,
they don't. Yeah,
right. But what it would mean is, though, if they were, if those who, those small number of banks and institutions who can buy on the primary market are buying up those bonds, and they're sitting there as their reserves in effect, and the secondary market disappears, then people who were buying stuff on the secondary market are not putting money into the United States anymore. They're making their secondary market purchases, buying bonds of other countries, buying in Europe, for example.
No big difference. I mean, the secondary sales aren't involved in the money creation process. In fact, when the banks sell bonds,
but they would impact the value of the dollar, wouldn't they? The fact that people aren't putting money into the US to buy up those bonds would mean that which is why we're seeing the value of the US dollar coming down.
Yeah, that'd be one of the factors. There'd be many, but that's going to. So the Fed's got a complete capacity to control the short-term interest rate. When they take on QE, the main difference between that and standard open market operations, apart from scale, is the fact they buy bonds across the entire spectrum, from 1 year bonds to 30, whereas the normal stuff they're doing is they're backstopping the purchases of all bonds of all maturities, but mainly they're trying to control the short-term rate. So they're trying to maintain a window around the maximum minimum of the short-term rate. They can do that, but they don't normally bother about the long end. So that's where you get these major fluctuations in the value of long-term bonds, and it particularly hits the valuation on the secondary market.
So when other central banks overseas buy up US Treasuries to sit in their reserves, I mean, that's just a portfolio balancing activity for them, and they'll just behave the same as any other institution that's trading. And if they look and say, "There's not a great, it's become more of a risk now in the United States. We're going to de-dollarize," which seems to be the trendy term at the moment. We're going to de-dollarize. I mean, that's what they're really talking about, isn't it? We're going to buy less US bonds in effect.
Yeah.
And we're seeing a lot of that happening at the moment, I think.
Yeah, and like the thing is, at some point the system was going to break, because particularly with Trump in the White House, I mean, people are looking at and seeing how the past weaponization of the dollar by Bush. Well, what the hell's Trump going to do when he decides to do the same thing? So in some ways you say, get your stuff out of America, so it's not beholden to the most neurotic political system on the planet.
Right.
Maybe the second most neurotic, but still.
When we come back, let's have a look at how which countries are buying and which are selling, and why did they have so many? Like China, why did China have so many US Treasuries in the first place? We'll look at that when we come back on the Debunking Economics podcast. So one thing we do know is that China has offloaded a load of US Treasuries, or US debt as people like to call it, but maybe we won't use that term. But they've gone from holding $1.3 trillion worth of US Treasuries about a decade ago to now 757 billion. So it's halved basically in 10 years. That is quite a move. Why did they have so many? And I know the answer, but I want you to tell me, why did they have so many of those treasuries in the first place?
Running a trade surplus. And this is one of the arguments I'm having with the MMT mob, which just makes me, I might go bald as well as grey through this particular argument. But when there's a sale of goods by China to America, you get a change in who owns the reserves, owns the US dollars that back that from America to China. And the simplest thing for the Chinese central bank to do, if it's the one that holds the dollars, is to exchange them for bonds, which at least can be traded and give a yield,
Right.
and that's the reason people go for bonds.
So somebody in China buys something for $1,000 in the United States. They're paying for it in US dollars. All of a sudden, they've got 1,000. They're selling it. Sorry,
selling is the way.
Yeah,
Yes, mate. That's
so
correct.
but argument's right. Apart from it's the completely wrong way around. So somebody in China sells something in America, and America says, right, well, we're going to pay that in dollars. So they give them $1,000. Whoever sold that now has $1,000. That's not the central bank, though. That's the commercial organization that's doing the selling.
There's all sorts of channels it can go through. And actually, we should get Tyrone on this. He's actually doing quite a large piece of work on this, Tyrone Keynes, at the moment. But what you have is that there's many channels through which those dollars can be held. Fundamentally, they're still effectively held at a bank account in the New York Fed. Predominantly, that's where the actual accounts exist. But it will go from one agency's hands to another. It might be the central bank that holds it. It might be a transaction through one of the vampire squids. So that's the dollar itself. But then the question is, what does the seller back in China do? Now they can decide to hang on to those dollars and change the nature of them from dollars to bonds and do nothing domestically, or they can decide to convert that currency, which again, it doesn't destroy it, it changes who owns it, convert that currency into renminbi, and that actually means that their bank accounts go up. So the export sale to America increases the amount of renminbi in circulation in China, anywhere between 0 and 100% of the level. Because if the firm, for example, decides they're going to hang on to that money or sell or use those dollars to buy American bonds, then at some point they want to then buy an asset in America, then they're going to convert those bonds back to dollars again, and then purchase an asset in America.
Right.
So this shuffling is going on all the time. Exactly the sort of thing that Keynes simply didn't want to see happen, because again, above all else, let finance be national. Well, so much for that good idea.
But if the company that was doing the selling took that $1,000 and said, well, actually, we don't want it in dollars. That's no good to us. We want it in yuan. Then they would sell it. But the bank that they sold it to would now hold those US dollars. And so how does the central bank in China suddenly become the holder of those? Because they're sitting in the bank, and so those banks sit in the reserves.
They're reserves, they're assets of the private banks which are involved in this, and therefore they're liabilities of the central bank.
Right.
This is the whole link, the same link that applies with reserves. And this is why you've got to do the double entry bookkeeping to the final dot.
Yeah.
And what annoys me, so many people say, all they're getting is American bonds. What can they do with that? Well, they can do a damn lot with it. Thanks very much. When you check for the follow-on consequences elsewhere in the double entry bookkeeping system.
Right. So the fact that the amount of dollars being held by China has halved over the last decade could be a number of factors. One could be there's just less trade going on. Obviously, could be part of it. There's just less US dollars being earned by the Chinese. But the other one could be the moment they get hold of those bonds, they decide they're going to transfer them into another currency. Although that wouldn't work, would it?
Or they could be deciding to buy American assets with American dollars. And this is right. Warren Buffett's lovely little case, which I've done another video on recently. The Thriftville versus Squanderville mind model that he made up. You have the Thriftville accumulate so many Squanderville bonds that they finally decide, let's buy Squanderville assets with the bonds. So they then sell the bonds back to the Squandervillians, and with the Squander bucks they get, they then go and buy assets off the Squandervillians, and they end up owning all of Squanderville. Now China has been building and again under pressure from America itself to say, rather than exporting, start producing domestically. I believe BVD is setting up a couple of factories in America. They've got to buy the land.
Yeah.
Therefore, you sell the bonds and convert them to American dollars, and then buy the American assets with that, rather than holding bonds.
So, if they've sold stuff to America, there's no way out of that, is there? You've either got to hold the bonds, or sell those bonds to buy assets in the US. Otherwise, you're still going to have that historic trade imbalance somehow sitting in the banking system.
Well, it's going to be running through the banking system all the time. So yeah, the initial thing, if you've got one country continuously exporting more than it's importing, so running a balance of trade stroke payment surplus, then they're going to be accumulating ownership of other countries, not their own currencies. Let's stick mainly with America on the importing side and China on the exporting side. They're going to end up with more and more American dollars. The easy thing to do is therefore use those dollars to buy bonds, so they buy the bonds on the secondary market. But equally, they can decide to sell those bonds, get American dollars back for them, and then buy American assets with them. So and I've seen MMT people are saying that you can write a law against that. Yeah, well, Australia has the Foreign Investment Review Board. I think it's turned down 2 investments in the last 35 years. Expecting lawyers to protect you on that front is rather than saying what's the economic tendency.
Well, no, they are very big on things like making sure that no more than 99% of people buying an apartment block are from overseas. That's that sort of stuff.
They hold the line for the final 1%.
Exactly.
Yeah.
There's got to be one Aussie in there. Yeah.
Keep out the homeless people. Don't let them buy a house. But if the millionaires want to buy a place, go ahead.
Now, some people are saying that Japan are, because actually what is happening is that we're seeing the UK and Japan are amongst those who are buying up US Treasuries. So that is not from the UK's that is not from the trade balance, because obviously in the UK's case they've got a trade deficit with the United States. But I've read people saying, well, Japan is buying for strategic reasons, that they think they'll have more leverage with the United States. So why now?
Sorry. Yeah, I mean, even the thought that it gives you leverage. I mean, again, this bond vigilante argument, which has been pumped up for decades by neoclassicals and rightly satirised by a lot of MMT on that same front. If you want to sell the bonds to America and think they're going to bankrupt the country and drive the market down, as I said, the Federal Reserve can buy the lot. What else you got?
Yeah,
it's easily neutralised. Yeah, you can't. And whether you're a domestic American or an international purchaser, if you think you can drop the market, then the Fed can say, "Oh, we'll buy that lot," and bang, they're gone.
So
it's gone. When did who was it in South Park? Was it?
I was
he went to the bank and made an investment. Oh, yeah, they put it in mortgage-backed securities and leverage, and it's gone.
Right. So the gold bugs, meanwhile, their argument is buy gold. And I said, it's up 25% so far this year.
Yeah.
And so, some people quite sensibly see that as a bit of an anti-inflation hedge. So if you're there in America, you see the value of the dollar going down. There's a lot of gold in America. You'll just say, okay, sell those treasuries, buy gold, because those treasuries are going down because the value of the dollar is going down. Buy the gold, because that'll probably hold up its value. The more people do that, of course, it's a finite resource. It's going to go up in value. So actually, it's looking pretty good until it's not anymore. You just need to know at the point at which it's not anymore. But in the meantime, it's a good hedge against the downward impact. So the inflationary impact, but also the fact that you could be losing a great deal of money as well out of your bonds because of the devaluation of the dollar. But that's one reason why people buy gold. But then there's the gold bugs who are there saying, well, look what's happening. That people are bailing out of US Treasuries because the dollar is devaluing, and that's because of government debt. It's fiat currencies. There's just too much money around. How can it hold its value when there's so much of it? And look, this is the start of something really big. And so let's get into gold, because it doesn't devalue like the dollar does. But I mean, if everyone was in gold, if everything was gold, I mean, that would be even more problematic. So I mean, we're going to reach a point where, there's too much of a battle for gold. I mean, imagine we know if everybody traded in gold with a finite resource, we'd get deflation because there's only so much of it to go around. You'd be trying
to get an inflated gold price. I mean, gold. I've always described gold as a speculative asset which does well during periods of financial turbulence.
Yeah,
that's what it is. It's not a substitute for money. It could be. It was used in terms of international trade as a way of notionally balancing trade imbalances in the days of what they called the gold standard. But you didn't go down to the local supermarket and buy a chocolate bar with a sliver of gold. That'll never happen. So it's always gold certificates that are involved in all that, and then you've got exactly the same issues about fraud that the gold bugs wave at the fiat currency system. Somehow we're supposed to believe those gold traders are going to be more honest than the allegedly crooked Federal Reserve. I'm not going to hold my breath on who's going to be more crooked. But fundamentally, yeah, I've got people. You're trying to find an asset which rises in value, and one reason that I think we're seeing turbulence on the value of the American bond is because the bond price is set by a bunch of neoclassical economists who know SFA about how the financial system actually operates. They're putting up interest rates because they believe that's going to reduce the rate of inflation. It's basically tangential to the rate of inflation. Consequently, if the interest rates go up, the value of bonds goes down. The longer term the bonds are, the more an increase in interest rates reduces their value. So people looking at that and sensibly looking at it and saying, the interest rates have gone from 1%. Maybe let's say 2% on long-term government bonds to 5%. Well, if we had bonds which had an infinite lifetime, the ones that were called the consols, that would mean a 2.5 times reduction in the value of the bond. So now, and that's where I think the Federal Reserve is damaging the reliability of American bonds as an asset to purchase into, which is partly undermining the demand for them. Because if you do buy long-term bonds and then the Fed puts up interest rates to allegedly control the rate of inflation, having bugger all effect upon it, that means your assets fall in value and you can be wiped out. So in fact, I think we can blame a lot of the volatility for the American dollar on the hands of the neoclassical economists who decide interest rates in the central banks.
Interestingly, of which Donald Trump is not one. Because actually what you've described just there is what Donald Trump, well, I mean, you might be putting it slightly more eloquently, and there's a few steps of logic that you might have missed out.
Oh, damn, I'm sorry, I'm going to remove those immediately. I know that they're offensive.
I don't like the logic.
The anti-woke is offended by logic.
Yeah. Oh, you got it, yeah. But I mean...
Some of the woke are too, frankly.
But his point is that, yes, we need to, put more simply, bring down interest rates because that's going to encourage investment and also stop that asset price inflation.
Well, to tell Donald Trump to sack all neoclassical economists from university departments around the planet and central banks, and he might do something good for once.
He might do that as well. It's the sort of thing, if you told him it's a good idea, he might do that tomorrow in a flash. All your problems solved, Steve. So I think
I'll get a few others out of the advice.
So from all of this de-dollarization then, so who wins and who loses? So... the U.S. Treasuries are saying are not really impacted by the whole situation. The impact really is just the flow of money into the U.S. slowing down and the impact that is having on the U.S. dollar. Is that the impact of de-dollarization basically in a nutshell, or is there more to it than that?
I think if it goes on for long enough, and you can get these critical breaking points in complex systems like our financial system. If it goes on for long enough, you will get the establishment of something like the BRICS have been talking about for some time, an alternative system for international trade. And that'll be the end of the dominance of the SWIFT system, and the Americans' exorbitant privilege will disappear. Now, that could mean, of course, a fall in the value of the American dollar even more when it first happens. But yeah, this is a great reason to design a trading system that doesn't use the American dollar as an intermediary.
Right, and it's not happening so far in terms of trade, not in a big way, not as much as the purchase of US assets, because there's no choice. Basically, it's not easy to move to another currency.
Yeah, well, it's possible, but there isn't an alternative payment system. It's something apart from SWIFT. We need another good acronym to go with that. But an alternative payment system using a basket of commodities could be used, and that then just means you don't have to consider having a portfolio of American assets anymore. And then that doesn't affect the capacity of the American government to sell new bonds, but it does affect the trading of them the reselling of them by banks and primary dealers on the secondary market.
Right, but what BRICS is trying to do, and we've talked about it in the past, that's unlikely to work because it's such a small. I mean, it's not a small subsection of the world, but it's a subsection of the world, and it
involves But Russia and Brazil, are fairly substantial economies. But the main thing that it includes the oil producers, and a huge amount of international trade is denominated in American dollars because of the SWIFT system. So if they start saying it's an alternative system, and that could have a huge impact upon the value of the dollar and the American dominated international payment system.
But if I'm an oil producer in the Middle East, for example, who's been used to being paid in US dollars because of the stability of the US dollar, if the US dollar is no longer stable, why wouldn't I go, well, okay, I've got to manage currency fluctuation now like I haven't done before. Look at this. I'm almost behaving. I've been watching Donald Trump too much. I'm doing the whole thing with the hands.
You are, yes. As soon as you start doing this, I'll get really worried.
That's the, so at some point, surely you're going to get oil producers, for example, which is a big chunk of world trade, saying, well, okay, there's no stability in the US dollar. So now we will just accept the fact that there will be fluctuations in currencies. They all level off anyway. If the US dollar's down, it's got to be up somewhere else. Why wouldn't oil producers say, pay in whatever your currency, unless you're a very small country. Well, but we'll take euros, we'll take CNY. We probably won't take the Russian ruble. But, Aussie dollar may be, New Zealand dollar, well, it's a bit dicey. But, they and just pay in whatever currency you want. Why wouldn't they do that?
China's possibly going to do that with the whole event over Iran. One of the arguments I've seen being pushed around the internet makes a lot of sense to me. The Americans are destroying their own system. Why not move to a country which is trying to build one instead? So you start using the renminbi as your yuan as your international currency. And one argument about if Iran did decide to block off the Straits of Hormuz, which apparently it hasn't done, that would affect oil supplies to China. Well, an alternative to China's could do it very rapidly. Build an oil pipe, have a correct connection, and then in that case you get oil flowing from Iran to China and renminbi flowing from China back to Iran, and then China conducting its trade for Chinese goods and largely forgetting about the Americans, because who buys American goods anymore anyway?
But the concern is that America has been weaponizing the dollar. I'm interested in your take on exactly how they've been doing that. But before you answer that question, why would we try and provide the same sort of weaponization to China if that's a concern?
Largely because China doesn't shoot you. I mean, this is the. I mean, I think I saw whether it's a real or a mythical account for President Xi coming out and saying China has been involved in no wars in the post-war period. I think that's garbage. I think there was I don't know whether China invaded Vietnam at the end of the Vietnam, what the Vietnamese rightly called the American War. That China did invade and got repelled by the Vietnamese. So there's one time that China was involved in a military incursion to another country in the post-war period, but once. That's once. Right? You want to count up America? I'm sorry, we haven't got enough minutes left in the show.
No, we're almost out of time. Absolutely, we need another hour or so. But okay, so how are they weaponizing the dollar then? What?
Well, it's largely because they're saying you can and cannot have access to SWIFT. Right. And they're telling Iran and Iraq, I think it was Iraq at one point, certainly it was Iran, that they can't use the SWIFT system anymore. And that means suddenly you can't make payments, you can't accept payments. It's incredibly disruptive. So the fact that America's been willing to do that shows they're not the right sort of country to be a custodian to what is supposed to be an international resource.
Right. So which gets back to, which we've spoken about a lot of times, what John Maynard Keynes had advocated, that there is a global reserve currency that nobody owns.
Or reserve unit of account.
Yeah. Which is
don't get out of all the currency effects are gone when it only exists inside a clearinghouse and you can't create it. Look at it. I mean, rereading Keynes's work on that, I just thought what a stroke of genius that was, because one thing I thought was in his proposal was to be able to create the currency and then use that for development processes and so on. That would involve a global government, We're talking chemtrails here, that sort of thing. And instead he said, nope, you can't even create it. It's just a unit of account.
No, it's a spreadsheet basically.
Sorry?
It's a spreadsheet basically.
A spreadsheet, where all the rows and columns, all the rows sum to zero because all the transactions, exports, global exports equals global imports.
which would be in this day and age would be quite easy to do, actually.
Yeah, much easier than when Keynes was talking. Back in those days, the only computers that existed were the ones that were breaking the Enigma code. So yeah, these days they're everywhere, and it's all electronic.
Don't you get the feeling then that we could be very close to that? That this de-dollarization could be the first. Because
I hope so.
Because we're de-dollarizing by not buying American assets to the same extent, but we're sort of like stuck using US dollars, but we don't want to because it's no longer stable. I mean, that could force a very rapid move to something else, and we are not going to move to CNY because we don't trust Russia. We're not going to move to the euro because anything administered by Europe's going to, it's ultimately going to fail, probably through bureaucracy. And BRICS obviously is politically contentious as well. So the idea that there's a neutral system that could be developed by a software engineer that is somehow managed in a way where it's foolproof without any single government control has to be the end result, doesn't it?
I hope so. That's the only thing I can say a positive out of Trump, throwing yet another crazy spanner into the works and doing it every week so he doesn't fall out of the news cycle because it's terribly hard to cope with the lack of attention. Then for Christ's sake, let's design this system and build it. Give the Americans an invite. If they don't take it, it's their problem. We're building a global system without a currency for international trade.
Right. Meanwhile, this de-dollarization is just going to continue, isn't it? The longer he stays there, the more he makes the country unstable. The more all those portfolios that relied on America as a safe choice and might have been occupying 30 or 40% of people's portfolios, all of a sudden drift down to 10% or whatever, and they're finding that safe asset. It's great for Europe because everyone's looking and saying, well, where's the next most safe place? It's probably Europe, just by nature of its size and the fact that these are all developed economies, even though they have their own problems. So a big opportunity because Europe's probably going to get a lot of investment from this now.
I mean, again, let's find above all else. Let's finance be national. I think the Europeans would be doing their own thing rather than relying upon foreigners coming in.
Yeah,
but they won't do it.
Yeah. They'll take it while they can. All right, very good, Steve. Catch you again next week. Thanks for all of that.
Yep. Okay. Yep.